Buddy, it is Wednesday, the 30th of November, 2016, and we finished with a little bit of loss here in the S&P 500, down a quarter of a percentage point. But we did close below the five-day moving average for the first time since this rally really began on that gap. So it puts us in a more cautionary mode. We are also below today's volume-weighted average price and the week-to-date volume-weighted average price. So what we'll be looking for is this as a potential little area of resistance up near 221 tomorrow, and if we are unable to get up through that level, then it's possible we could experience a little bit deeper pullback. I wouldn't short it just below this level. Instead, as we like to do, we'd like to see it maybe flush down below there and then rally up and fail below what would be a flat to declining five-day moving average at that time. But right now, it just gives us a reason for caution. It does not give us a reason to say, okay, we've got to throw our stocks away and get short everything, because we're still in a primary uptrend. And if we do pull back, I think that the downside will be limited to somewhere in this prior band of resistance. The NASDAQ is down towards the midpoint of the range. It closed right pretty much just below that 50-day moving average. And this is where we've seen a lot of activity in this market, for the last several months here since the beginning of August, as this market is building energy for who knows what. But because the primary trend is higher, I still think that the energy is being built for further upside. But when we look at a 5-minute, 15-minute time frame rather, with a five-day moving average, what do we see here? We're below a declining five-day moving average. So that tells us we need to be cautious in here. Does it mean we get aggressively short? I think absolutely not. But if it rallies up and then fails, then we would want to get short for shorter period trades, not for swing trades, not looking for a top, etc. The Russell 2000 is also, we've seen that this has been battling with its five-day moving average here a little bit the last couple of sessions, and now that it's broken below and closed below that five-day moving average, and the five-day moving average is declining, well, we want to look at this now with a much more cautious outlook. If we see strength up towards that five-day moving average, we're now going to say the intermediate term trend is now guilty till proven innocent, as long as we're below 133.10. However, because the bigger picture is still trending higher, don't get too aggressive on the short side, and certainly don't chase a market that is already made a decline. Wait for it to rally up, and then once it begins to start to roll back over again, then you look to short smaller positions, and of course, keeping your stops tight. The semiconductors, which we were stopped out of 2 days ago, that was the correct place to be stopped out of, and now we're seeing this market trap below its five-day moving average as well. The bigger picture is still a primary uptrend here, so again, we don't want to get overly bearish here, but it is prudent to be a higher cautionary level, and intermediate term right now is guilty till proven innocent until it's back above 71.50. The biotechs continue to pull back here, showing no signs of support. They are actually down right now once again to the year-to-date volume-weighted average price. So when we drop that in there, you can see that we're right on the year-to-date volume-weighted average price. Coming into this week, we were looking for the potential that this group could turn higher, but of course we've seen no reason to purchase, because we were looking for stability first, and then we were looking for the market to show a pattern of higher highs and higher lows above a flat to rising five-day moving average. And we spoke about this as an important level of resistance up in here. So this was the potential. So as always, we anticipate all potential scenarios. It looked like the right idea to anticipate that the biotechs could move higher this week, but we wait for price confirmation of our theory before we actually commit our hard-earned capital to that long side trade. So being involved right now obviously has been a losing proposition this week, and there is no reason to be involved on the long side, not while we have this declining five-day moving average, and this puts it back in jeopardy again. But we'll still keep an eye on this. I don't think that we're going to see a major failure here, not with the year-to-date volume-weighted average price, and the fact that we're still within this much bigger neutral zone with a band of resistance up here and the bigger band of support in this area. And here we are right back towards the midpoint of that range, and on the 200-day moving average, as well as the year-to-date volume-weighted average price.